So in this short video, we are just going to go over the simple equity section calculations that were in the Class 4 notes. So what we were given here is a total asset level for the business, a total debt level, and then two components of equity. Remember, in this small business class, the way that we approach the equity section is there are three separate possible sources of equity. One being contributed capital, again, external funds provided to or given to the business, brought into the business from outside by the business owners. Retained earnings, which is internally generated funding or internally generated equity from income that is retained in the business. So rather than being distributed to the business owners through family living withdrawals, a portion of income may be kept within the business, and that would be referred to as equity from retained earnings. And then finally, the third component is valuation equity, and that is equity that comes from fluctuations in the asset values that the business, of the assets that the business holds. So valuation equity would come from changes in the machinery and equipment that the business holds, perhaps financial assets that the business holds, real estate, or some of the other long-term or financial assets that might show up on the business's balance sheet. All right, so the first question we're asked here is, based on those four pieces of information that are given, what is total equity? Okay, and hopefully this calculation was pretty straightforward. It was obvious how we get the total equity value from the information given. First of all, we're given more information than we need. The only two pieces of those of the four items that we know that are needed are the total asset value and the total debt level. So total equity in this case would be $400,000, or A. And the way that we should arrive at that number is simply relying on that fundamental accounting identity: assets equals debt plus equity. So assets minus debt will equal equity, or $1 million minus $600,000 gives us the $400,000 total equity balance for this business. Next question is, what is the firm's contributed capital balance? Okay, so again, contributed capital is one of the components of equity. We are given the other two components of equity, retained earnings and valuation equity in this case. And in the previous calculation, we had used the total asset and total debt levels to find the firm's total equity. So now we know total equity, which was $400,000 from the previous calculation, and we also know retained earnings and valuation equity. So using that information, what is the firm's contributed capital? We'll take a few seconds here to think about it and then see the answer in the next slide. Okay, so hopefully it was clear how you should use what we now know to get the firm's contributed capital balance. So if we know total equity of $400,000 and we know two of the three equity components, we should be able to quickly calculate what the third component of equity is. So if we have $400,000 in total equity and $150,000 in retained earnings and $150,000 in valuation equity, the remaining component, the difference between the total and those two, should give you the third component, or the contributed capital balance. So if we take $400,000 in total equity minus the $150,000 in retained earnings and the $150,000 in valuation equity, that leaves us with the remaining $100,000 that must be the firm's contributed capital balance.